Welcome. My name is Leslie Miller, and a little bit of housekeeping before we get started. We ask all the participants to update your screen name and include both your personal name and business name if you can. Always welcome to put it in the chat. We are recording this and we'll have this information available to you after the event is over. Because we have a smaller group here, after we do our major introductions, then we'll go around and let everybody kind of introduce themselves. But for right now, I'd like to introduce to you Aisha Kadri, who is the project director for the Small Business Transportation Resource Center, and she will be the host. And we also have with us representing the Port of Seattle, Tina Boyd. So I'd like to turn this over to Tina, and she has a few words to say to you.
Hello, everybody. Good afternoon. I'm Tina Boyd. I'm the Diversity Contracting WIMBY and DBE coordinator. And again, welcome to the first Port of Seattle PortGen Advance Goods and Service event. I want to personally thank the North Small Business Transportation Resource Center and the many other partners involved in the training. I know about the success of last year's event, and thank you, Tamika Thornton, for all your hard work in this event. And I want to also ask you to take advantage of this opportunity. We provided the platform here for you to learn about the agencies themselves. So come prepared with all your questions. We are here for you, and you will be, I will also be in and out of these training events. Many of you I might have met before in the past PortGen's events that I have attended. But I just want to let you know, if you have any additional questions, feel free to contact me directly. I'll make sure that you have access to my email. Again, enjoy yourself. Thank you. I'll turn it back over to you, Leslie.
Well, thank you, Tina. And actually, we see that Tamika just signed in. So I'd like to introduce Tamika Thornton from the Port of Seattle. And we'll ask her to do a few words to the audience also. Thank you.
Hi, good afternoon, everyone. Thank you, Leslie, Tina, Jessica, Aisha. It's nice to see everyone. Similar to Tina, greetings, everyone. This is, of course, our second, year doing this. We really appreciate SBTRC for partnering with us, as well as PTAC. You will learn some valuable information. I always encourage networking, asking questions. You'd be surprised sometimes the question that you want to ask, someone else also wants to ask as well. But again, please take all the notes. Again, we are here, as Tina said, to answer any questions and to help you along the journey to not only engaging, but at the same time building up your business as well as your network. So again, welcome and thank you again for partnering with us, SBTRC and PTAC.
Thank you, Tamika. Well, I think that we have a few extra minutes, and what I would like to do is maybe have a few of our participants introduce themselves, and I think that we will start with how about Yvonne Brandon? Can you introduce yourself and just give us a really quick overview on your company?
Oh, certainly. Well, I'm Yvonne Brandon, and my company is Brandon Multi-Channel Marketing Services. I have to confess that I'm actually retired now and have come out of retirement to help conduct these workshops. But I'm excited for the opportunity, and it just sounds like a perfect fit for helping people understand how they can use the multi-channels that are out here now. It's not just the website anymore. It's website and thousands of potential opportunities in the social media stratus. So I'm excited to put that together for people so that they understand how to use it efficiently.
Thank you, Yvonne. Next, we'll call on Joe Saxton. Joe, are you there? Can you give us an update about you and your company?
Yes, can you hear me?
Yes.
Yes, hey, I own an IT company up in Alaska. We're just involved in doing smart cities and smart automation and things.
Oh, wow.
So I signed up through PTAC Alaska, and that led me to PTAC Washington. So I've just been following it, learning from the professionals on how to do government contracting and kind of just understanding the lay of the land. So I saw this workshop series was quite informative. So I signed up to kind of learn, so that way when and if the opportunity presented itself, I could do business in that great state.
Well, thank you, Joe. We're glad that you are here to represent the great state of Alaska. Thank you.
Thank you.
Next we have Lisa Harbert, and Lisa is from Harbert Engineers. So Lisa, if you can give us an update about your company and you.
So my camera's not working today. I'm Lisa Harbert, and I have a small 2-person engineering firm. We do stormwater, mostly residential.
Mhm.
So our saying is, because it's going to rain and have car will travel, but we do mostly around the Puget Sound area.
Thank you, Lisa. And last man up will be Andrew Miller. Andrew, give us a little overview about A. Miller Consulting.
Oh, that's pretty much the whole nutshell. I'm a small business consultant. I do a lot of just reaching out to people who are having struggles. You know, your basic businesses that are big, you know, your Amazons, your big companies. I'm never going to touch those. But if you have a shop manager turnover and you can't hire a new guy, I'm the one that'll come in and help you kind of tune up your stuff and keep the place going while it's floundering. Then I pull you out of flounder and get you back on your feet. So being a little different the last year or so, not being able to get as many opportunities, I just kind of parked everything, and now I'm getting my feet back in the water, and these workshops are pretty much the best way to do that. Warm back up on everything and get used to a Zoom life.
Okay. Well, thank you, Andrew. And with that, I think that we are going to get ready for Mr. Pete Miller from Clarke Nuber. Clarke Nuber is one of the major accounting firms over on the west side of the state. And today he's going to talk to us about all those really fun things like business taxes and financials, and how to develop some strategies. So Pete, are you ready to go?
I am. I'm going to share my screen here.
Thank you.
Present. Maybe start at the start. There we go. Can everybody see that? Thumbs up. Yep. Head nods. Great.
Yeah.
Yes.
I just a couple things before I get started. I love the collection of Millers on the call. There's 3 of us, and you know, there's some kind of unity there, I think, that was unplanned, but nevertheless, I'm a fan of. Yvonne, I saw that you had a furry office mate there that was wandering around your desktop, and I've got a couple of those too, and I'm tucked away in my home office, so hopefully mine will leave me alone while I'm talking, but you never know these days. So welcome to your furry friend as well to the call. So just a little bit about myself and Clarke Nuber. Clarke Nuber is an accounting and consulting firm. We're located in Bellevue, Washington. We're about 250 people. We've been around since 1952. I've been with Clarke Nuber for 21 years. It was my first job right out of school, and I started at Clarke Nuber. I haven't ever looked back. And we serve, small to medium-sized businesses, largely in the Puget Sound region, although we have pockets of clients up and down the coast and really across the country. But for the most part, we're serving companies in Washington, companies and not-for-profits, and then the owners of those companies as well, doing audits and tax returns and consulting on state and local taxes or IT security, or providing accounting and controller CFO type services on a fractional basis, and a variety of things of that nature. So really a full service accounting firm, like I said, 250 people. And really nice thing about that, we're all located in one office, which is fairly unique for a company of our size to have everybody located in one place. And what that does is provide an opportunity for some really deep and detailed expertise in specific areas. Like I said, we've got a team of about 6 or 7 people that do nothing but state and local tax support for our clients. We've got an international tax team. We've got 20 to 25 people that are in that controller and CFO group. But the really neat thing is that we're all in one place. And I've really liked that. I like the ability to either walk down the hall or at least know all of the professionals that I work with. And if I need somebody's help, they're just as invested in the ownership of that client relationship as I am. And so they'll jump in and likewise. So we're really collaborative that way and helpful. So anyway, just a little bit about Clarke Nuber. So what I wanted to talk about today was really, the title of the presentation is Financial Statement 102. And so what I'm not going to talk about is really like the bookkeeping and things of that nature, but I want to help you decipher what financial statements are, how that accounting information is used, and primarily what outside users are looking for. And a lot of our clients ask the question of, well, what do I need to do to get myself ready for financing, or what are outside companies going to be looking for when they are examining my business? So I want to go into a deep dive there and help you understand what that looks like. And then one of the things that they often do ask for is some kind of CPA report on financial statements, not necessarily an audit, although an audit is one of those things, but some kind of reporting from a CPA. And there's some misunderstanding and complexity around that I want to try to unpack and decipher for you. So we'll talk about that as well. So the first thing is kind of back to basics. There's a variety of different things that you can do with accounting information, and the way that you account for things really depends on the purpose, why you're doing the accounting to begin with. And there's a variety of bases of accounting or uses of accounting. Then I'll go from the bottom up on this slide here. The first is really what I refer to as managerial accounting or your internal accounting. And this is what you use to run your business. It's not just a checkbook. It's not just a way to understand if you how much money you're making and how much money you're spending. It does do that, but it's also a way to help you understand, am I running my business in a way that's profitable? Are the projects that I'm working on, the customer relationships that I have, are they profitable? Am I making money? Am I making enough money to fund the things that I need to do from a business standpoint, like pay for my overhead, pay for my taxes, pay for anything else? So those kinds of things are important, and there's some distinction there we'll get into. Another reason why accounting is important, particularly for a business, is because businesses have to file a federal income tax return every year. And regardless of the way you're incorporated, if you're an LLC, if you're an S Corp, if you're a C Corp, you still have to file a tax return. And that takes some pretty detailed and a rigorous accounting in order to do that the right way, and in order to take advantage of credits and deductions and all those kinds of things. So accounting is really important for that. However, the methods that you use and the techniques that you use are going to be different from managerial accounting and federal income tax reporting. Slightly different. So there's a couple of different reconciliations and things that need to be done there that we'll talk about. And then kind of over and above that is a really formalized method of accounting called Generally Accepted Accounting Principles, or GAAP for short. And GAAP is what more sophisticated external users are going to be looking for. And the reason that they're looking for it is kind of in the name. It's generally accepted. It's a universally accepted method of accounting, so that if you're talking to a bank about getting financing, they will know that the numbers that they're looking at are apples to apples with somebody else that they may be looking at as a comparison, or another customer of theirs. They'll know that the financial statements were prepared with that basis of accounting in mind, and with the same methods and techniques that others use. So saying that your financial statements are in accordance with GAAP is really important for that audience. So let's dive into that first one, and now we'll kind of go from the top down. I'll start with the generally accepted accounting principles piece. And with generally accepted accounting principles, a key tenet in this basis of accounting is the fact that it's based on historical cost for the most part. And what that means is, you know, if you're buying a piece of equipment, if you're buying a piece of inventory, or if you are transacting with a customer, you issue an invoice, the original price or the original cost that goes along with each of those transactions is going to be the cost that you carry for the most part through the transaction, the cycle of the transaction. What it isn't is, let's say that you buy a piece of inventory and it's a coil of sheet metal, for instance, and you pay a certain price for that sheet metal as of a point in time, and 3 months go by and you still have that sheet metal in your warehouse. If the price of steel has gone up, you're not adjusting your inventory. You're leaving it based on that historical cost, what you paid for it. So that's important. Otherwise, accountants would be kept very busy trying to determine what the fair value or the current market value is for all of these things. That's not what we're doing. It's this historical cost. So I think that's really important. There's 4 required financial statements that come along in an annual report under generally accepted accounting principles. The first is your balance sheet, and that's a snapshot as of a point in time. It's really designed to understand the health of a business, the financial strength of a business, where you're at as of a point in time. It captures your assets and your liabilities, and we'll talk more about this, but it's really, that's what its design is to figure out, you know, what kind of health are you in right now as a business. The income statement is your performance over a period of time. So here we're measuring the revenues that you've earned over that period of time, your expenses over that period of time, you know, how much money are you making from a gross margin standpoint, net income standpoint, how are you performing over that period of time. And then within that, there's a couple of other statements that drill down on specific elements of the balance sheet. And one is owner's equity. So, you know, as I said, a balance sheet captures your assets, it captures your liabilities, and the leftover generally is your owner's equity. You know, what have you kept inside the business to help it grow and to give it some resources? And banks and other users like to really understand, you know, what's going on inside of that specific balance. Are you issuing new stock to new owners? Are you paying distributions for tax purposes or for any other reason? And how much of your net income on a year-over-year basis are you keeping inside of the business? And how much of it are you distributing out of the business? So they like to see some of the detailed transactions within that specific balance. And then also the statement of cash flows is probably one of the least understood statements of these 4, but I think the most valuable. It really helps you understand where's your cash coming from and how are you using your cash? Are you using it to reinvest in the business, to go buy more equipment? Are you using it to pay owners in distributions? Are you making enough money to pay your bills? So we'll go into more detail there, but statement of cash flow is really important. But those are the 4 basic financial statements. So we'll get into some of the specifics. So first on the balance sheet, what do you own and what do you owe? And one of the fundamental accounting equation that's built into the balance sheet is that assets is equal to liabilities plus this owner's equity. And you typically see it presented with assets on the left-hand side, liabilities and equity on the right-hand side. I've got some examples of what those things are. So things that we own, cash equivalents, marketable securities, stocks and bonds and things like that are definitely things that we own. Accounts receivable are unpaid invoices that you've issued to a customer. So you do some work and you issue an invoice. If they haven't paid it yet, that's still an asset for you because it will be converted to cash, hopefully fairly soon when your customer pays you. If you're a business that maintains inventory, when you purchase inventory before you sell it, that certainly is an asset of the business, something that you own, it's tangible. Work in process is for service businesses, and I know there's a few of those on the call here. For service businesses, this is kind of like human inventory. It's time that your engineers, your service professionals have invested in a particular project but hasn't yet been billed. So, Clarke Nuber, an accounting group, we have work in process. So our people enter their time on a daily basis, and maybe we send out bills once a month, sometimes less frequently than that, sometimes more frequently than that. But regardless, if there's unbilled time, that gets captured as an asset for us, and certainly as an expense. So that gets captured, and it's called this work in process. And then once we bill it, it converts to accounts receivable. Once we convert it to an invoice and we bill it. And then above that, if we were buying long-term assets like computers and warehouse equipment and vehicles and furniture and things of that nature, that gets captured in this property and equipment, and that's depreciated. We don't write off property and equipment right away for generally accepted accounting principles. We capitalize it and we hold on to it for a period of time, maybe 3 years, 5 years, 7 years, and we depreciate it or write it off over that longer period of time, not right away. More and more these days for tax reporting, you're able to depreciate things in a much more aggressive way. They call it accelerated depreciation or bonus depreciation, where you get to write things off really quickly and then sometimes entirely right away, kind of as an incentive for people to invest in capital and to invest in additional equipment and help boost the economy. And there's other long-term assets that are created as well. On the other side of the ledger, a few examples, you've got accounts payable, and much like accounts receivable, this is the other side of the equation. If a vendor or a supplier for you has issued you an invoice, but you haven't paid it yet, that still gets captured. The expense needs to be recorded, but you put it in this accounts payable until you pay it. It's just a good way for you to track it. Similarly, accrued expenses are something that either doesn't really have an invoice attached to it, or perhaps you haven't gotten the invoice yet, but you know it's coming, like a utility bill. That's a good example. The utility bill's coming, it's going to be $500 a month. So you're going to record that expense in the period when you use those utilities, but you haven't gotten the invoice yet. More commonly is payroll. So you know that you're going to, let's say you pay your payroll on the 5th and the 20th of the month, and the period covered is for the last half of the month paid on the 5th and the first half of the month paid on the 20th. That expense is going to be captured, but you haven't paid the bill yet. You still capture that as a liability on your balance sheet for the amount that you owe that has been accrued for the second half of the month until you pay it on the 5th, for instance. And then long-term debt. And long-term debt can be a mortgage, it can be a line of credit, it can be a vehicle purchase that you finance, things of that nature, but typically things that are going to be paid out over a number of years. And we break that down into a current portion and a long-term portion. The current portion are expected payments over the next 12 months, over the next year, and long-term debt is something beyond that. And then remaining underneath liabilities, you've got equity, and so you've got stock that maybe you've issued if you're a corporation, and you've got retained earnings, or kind of the leftovers. How much of that net income are you leaving in the business? So one of the things that outside users really care about is something called a current ratio or working capital. They kind of mean the same thing. And it's a breakdown of current assets and current liabilities. And it's basically a measure of, do you have enough assets on hand right now to pay your bills? And assets can be cash. It can be receivables that are going to be converted to cash soon. It could be inventory that's going to be sold and then converted to cash when the receivable is collected. So it's just a measure of are you able to keep up on your bills right now? And your bills are measured by the things on the other side of the ledger, your payables and expenses and debt load over the next 12 months. So you compare those. And if it's working capital, the equation is current assets minus current liabilities to come up with a dollar amount. If you're looking at a current ratio, it's current assets divided by current liabilities. And the hope there is that that ratio is 1 or greater, which means that you at least have enough current assets to pay for your liabilities. And that's a signal of a healthy business. So that's a balance sheet. So the income statement is kind of, I think about this as a scorecard. How are we performing as a business? And this measures your revenues and your costs. So there's a couple of headers that I think are important here that I want to go through. Your revenues, the money coming into the business, and then your expenses get broken down into a number of different categories for generally accepted accounting principles reporting. There's costs that are specifically associated with selling your products or providing your services, and the label there is cost of goods sold. So any costs that are specifically associated with delivery of your services or providing your products is captured there. And then the subtotal of revenues and the specific costs to do those services is called gross margin or gross profit. So that's a measure of basically, am I making money purely based on what it costs to sell my products? And then beyond that, you've got a number of supporting costs or overhead. You've got selling costs. You've got corporate costs, general costs, or administrative costs. And then you've got these other expenses that I talked about earlier, this depreciation of your property and equipment. You add all of those costs together and you see, well, do I have operating income? Am I still making money based on the amount of revenue that I sold? And then even below that, outside of your operations, you've got costs associated with financing, interest expense on a line of credit or a mortgage, and then you may have some non-operating kinds of income and expenses. So that's what the income statement is telling us. And I've got some labels here. I didn't advance the slides fast enough, but really, what this is telling us is A, am I making enough money to earn a profit based on selling my products alone? And then B, am I making enough profit that I can cover my overhead costs and still have some money left over? And then C and D, really, do I have enough money left over to pay for the interest on my loans and to pay income taxes to the federal government, and then eventually, hopefully, to yourself as an owner? So that's what that's telling us. One of the key things before I move on that I think is interesting, there's this phrase that gets tossed around quite frequently amongst users of financial statements called Ebitda. It's a weird word, and it actually has, it doesn't have any, there's no formal definition of Ebitda found within generally accepted accounting principles or the accounting literature at all. It's just a term that the business community has developed and used quite universally. But Ebitda is really a measure, it's a proxy to your cash flows. And I'll talk about that here. I'll advance the slide to show you what Ebitda stands for. Excuse me. You can see that it's earnings before interest, taxes, depreciation, and amortization. And what Ebitda is trying to measure is the cash flow of the business specific to its operations. So two things that I said there. One is the cash flow of the business. And if you look at the last two lines on the definition here, depreciation and amortization, there's not cash involved with those expenses. You paid for a piece of equipment 3 years ago, and you're depreciating it over a 5-year period. Any depreciation expense that you're recognizing this year, you didn't actually send out any cash as a result of recognizing that expense. You're just writing off the equipment that you bought 3 years ago. So there's no cash associated with that. And so the reason that this gets added back when we're calculating Ebitda is to help businesses measure their cash flow performance. So, that's one part of this definition. And like I said earlier, it's measuring the cash flow of your operations. So that's the cash flow piece. The operations piece, the reason that we exclude interest and taxes is that really those two things don't have a whole lot to do with your operations necessarily. Interest has more to do with your financing activities. If you were to look at two businesses in the same industry, one of them may make the choice to finance the purchase of vehicles or the purchase of warehouse equipment or anything else, and the other business may look to just pay for those things straight with cash and not finance it. The first business would have some interest expense that would be recorded on its income statement. The second business would not. None of that really has anything to do with the performance of the operations of the business. And so that's why we back out this interest. And the same thing can be said for taxes. One company may be incorporated as an LLC, and therefore the tax consequences of the operations flow through to the owner of the business and no taxes are recorded at the company level. And the other company may be incorporated as a C corporation, which means that actually taxes are paid by that company and they don't flow through to the owners of the business. They get paid for right at the corporate level, and therefore those taxes are recorded on the books of that business. And so we're trying to normalize the operating performance and cash flows of these businesses. So that's what Ebitda is intended to measure, and that's why we're backing out these things. We look at net income and then we add back all of these things: interest, taxes, depreciation, and amortization. So that's a word that gets thrown around a lot. It's a key thing that helps measure the performance of the business. So that's why I wanted to walk through that with you. And the other two that I wanted to touch on. Oh yeah, there's a question?
Yes, Pete. You touched on the general accepted accounting principles earlier, where it goes according to historical cost. So as we've seen with a lot of raw materials recently have gone up in price and maybe have gone down quite a bit. The inability for a lot of small business to obtain supplies, where does it go on this Ebitda? Does it go on under increase of cost of goods sold just because they're not able to complete the job on time?
So I'll back up to here. Maybe this would be a better way to look at it. And I'll clarify. So supply chain issues, the ability to get inventory, the ability to push through price increases to your customer, all of those things are certainly complications that we've experienced in the last 12 months. Those costs are real, and certainly to the extent that you're paying for inventory at an elevated price, whether you're able to push that through to your customer or not, when you sell that inventory, it does show up in your cost of goods sold. It would show up here. And if there's delays to the execution of a project, it doesn't really impact your income statement so much. It just delays the recognition of revenue and perhaps the recognition of some of these costs. Those costs would just sit in your inventory balance or your work in process balance on your balance sheet for a longer period of time until you're able to bill it or complete the project. Does that help answer the question, or can I clarify something?
Yes, it does. Thank you.
Great. Excuse me. Okay. So, okay. Here, what I mentioned earlier was that there's two parts of the balance sheet that generally accepted accounting principles requires us to drill down and provide more detail. And within the area of owner's equity, there's a number of different categories, but a schedule like this is typically presented in financial statements. It just shows, where did we start at the beginning of the year, January 1st, and then what happened in buckets and kind of summarized, not blow by blow or every single transaction by any means, but what happened throughout the year, and how does that measure up with where we ended up at December 31st? So did we issue any new stock? Did we provide for a dividend or a distribution and pay out money to the owners? Did we make any money, or did we lose any money, and how was that treated here in earnings? So the balances that you would have at the bottom of this schedule would absolutely connect with and tie out to what shows up on a balance sheet. In fact, if they don't, that raises a flag and a question mark. So we would expect to see these things talk to one another. But this just provides another layer of detail to show, hey, how did this change? And for the most part, many of our clients really just have these two buckets here, the dividends and distributions and the net income that's coming through here. So from time to time, there's some more complicated things that flow through. But for the most part, they make money, they take some of that money and they pay it out to their owners as a distribution, either to reimburse them for tax payments that they have to make as an LLC owner or an S corporation owner, or they pay that out as a return of profit, basically. So that's what this is getting at. Okay, so now on to the statement of cash flows. And like I said earlier, this is it's one of the more difficult statements to comprehend and to build, but it provides a tremendous amount of information. And it's kind of where I flip to first when I'm looking at the health of a business. And this breaks down your use of cash or your production of cash into three different buckets. And first, we start by looking at your operations. And we start with net income. So let's start with your bottom line. Maybe you made $100,000. Some of that was depreciation and amortization. And we already talked about the fact that that's not a cash transaction. So we're going to, and that was a deduction from your net income. So we're going to add that back. So maybe that's instead of $100,000, if we had $10,000 in depreciation, now we've got $110,000 of cash flow. And then there's some timing differences. There's timing differences in when you record an account receivable, for instance. You issue an invoice to a customer, but you haven't collected that cash yet. And so an account receivable, yes, you've earned revenue there, but you haven't collected the cash. And so there's a timing difference. The same is true on the other side. You've issued a supplier has issued you an invoice, and you've recorded the expense, but you haven't paid for it yet. So we capture some of those timing differences in the working capital accounts, and we make our way down to what's called operating cash flows. And for the most part, a healthy business that's going to be a positive number. Your business should be generating operating cash flows as a healthy business. And for many reasons, there's times when it doesn't, and it's a negative number, but for the most part, we're looking to see a positive number there as a source of cash. Our operations are building up a collection of cash for us to use in a variety of ways. The next two buckets kind of, for the most part, speak to how are we using our cash. Maybe, and the next one is called an investing cash flows. The word investing, I generally relate to in like stocks and bonds kinds of investing, and it can mean that, but that's not what it only means in this context. An investment could also be made in equipment, in vehicles, in a warehouse, in a building that you purchase. Capital expenditures or CapEx. And so if you're using cash to pay for those kinds of things, that gets captured here. If you're using cash or to buy and sell investment assets, that gets captured here too. And so for the most part, this ends up being a negative number because you're using cash to pay for expenditures like a building or vehicles or equipment and things. So that's a use of cash. And the third bucket is the financing cash flows. This can be a source of cash or a use of cash. If you got a new loan this year and you got a bunch of money as a result of getting that loan, that would be a source of cash. If you got a loan in a previous period and you're just simply paying it down, that would be a use of cash. And if you're paying your owners in distributions, that's a use of cash too. And so for the most part, what I'm looking at for-profit commercial businesses, I'm looking at positive numbers for operating cash flows, negative numbers for investing and financing cash flows because they're using cash in those areas. And so then what you do, you add up those three buckets, and it should match up with the difference in cash on your balance sheet between January 1st and December 31st. So it's a bit of a puzzle to find out, well, where did all the cash go and so on. But that's what this is telling us. And it's a more detailed look at the health of a business than maybe Ebitda is as a single measurement point, or simply looking at a balance sheet as of a point in time. If you use that in conjunction with this statement, and you look at that point in time, you're also able to see, well, over a period of time, was the business able to generate some cash flows so that it can use those monies to do the things that it needs to do to further the business. Okay, so those are the basic financial statements. And when you're preparing an external financial statement that's based in GAAP, one of the things that needs to happen is these things called notes to the financial statements. And footnotes or notes to the financial statements provide a greater depth and detail about your accounting policies and about the things that are showing up on your financial statements. It really helps tell the story of what the financial statements are telling us in numbers alone. It provides some narrative, some depth, some context for how you're accounting for certain things, and any additional details that need to be explained that maybe are attached to an unusual transaction or something new. It provides kind of some skin on the bones from what those financial statements alone are telling you. And then it provides some other important details about the company, things that just don't show up on financial statements. For instance, right now, if you have a lease for an office building or an office space, that stream of payments doesn't show up on your financial statements as a liability. It shows up on your income statement as rent payment, perhaps, but not as an ongoing commitment or a liability. And so that's one of the required disclosures in these notes, is that you describe lease commitments that you have, and you provide a table of how much you're going to pay in lease payments over the next 12 months, and actually for every year over the next 5 years, how much you're going to be paying in leases. So it just gives the reader a little bit more information, some additional context, and it's really, really an important part of understanding the story of a business and where they're at. Other key disclosures I'll just talk through really quickly to give you a flavor of what those look like. A description of the business and the reporting entity. Are there subsidiaries that are included in this? What does the business do? Where do they operate? Who do they serve and where? Those kinds of details are described. All of the asset and liability categories are described in a little bit more detail to help the reader understand how things are accounted for. There's quite a bit of requirements around revenue recognition and the timing associated with that, how the revenue is calculated, how it's billed, things of that nature are all described and required to be disclosed. The terms and maturity of your credit facilities and other long-term debt, those details are required to be disclosed. If you have concentrations, if you're a business that For instance, I've got a general contractor that I work with that builds Costco's, and Costco is maybe 90% of their business, and other retailers are the rest of their business. But that concentration with Costco is something that's required to be disclosed, and it's a tremendous asset for the company, and that they have a really rich relationship with Costco. But what would happen if Costco all of a sudden decided not to build any more warehouses, or if they decided to stop doing business with that company? That company would be in a world of hurt. They'd be in a heap of trouble, and how would they come out of that? So disclosing that concentration as a risk is something that's required. That's why we do that. And then related party activity. So if a classic example of related party activity is as a business owner, let's say that you buy the building and you put it into an LLC, and the operating business operates, uses that building as their headquarters. And there's a lease set up between the operating business and the real estate LLC. And the operating business is paying lease payments to that related party. That kind of activity is required to be disclosed because there's a presumption that it's not at an arm's length. There's a presumption that the operating entity is getting a bit of a deal, or could get a bit of a deal, because of this related party nature of the transaction. So that's required to be disclosed. And then other commitments that you come upon, like the lease commitments I talked about earlier. Contingent liabilities are captured in these notes, and an example of that might be an ongoing lawsuit, or something else that has been put on the company. Those kinds of things need to be disclosed too. Okay, so quickly, I want to touch on a couple of these other purposes and uses of accounting data. I talked about tax a few times, and there's specific reporting and ways that you have to account for things for federal income tax reporting. The Internal Revenue Code is the codification where that information resides. Obviously, you're preparing for federal income tax reporting, and there's differences in the way that things are accounted for book purposes, and I put that in quotes. Book in this context is equivalent to generally accepted accounting principles, and there's differences between book and the way that things are treated for tax. Depreciation is something I mentioned earlier. Generally speaking, depreciation happens quicker. You're able to deduct things a lot faster for tax purposes than you are for book purposes. Meals and entertainment for tax purposes gets recorded at 50% of the cost. So if you take a customer out to dinner and you pay $100 for dinner, you only get to deduct $50 of that for tax purposes. Whereas in generally accepted accounting principles, you would reflect the entire $100. So that's a difference. And there's other differences like that. But that's the reason why you need to kind of keep track of things differently for tax reporting, is because of many of these differences that can float up. You've got to have some visibility to be able to calculate those things. And then for internal reporting, sometimes you need more than what GAAP requires in order to analyze your business. As a manufacturer, for instance, would want to look at things at a different level. A service company with human resources that are providing consulting services and so forth would want to look at things a little bit differently. You might want to look at, is a department profitable, or how much work is a department doing, or a division, or even down to specific project or a customer relationship. There's greater detail and more layers to a business that if you're analyzing it, you need these details in order to make some meaningful decisions. So internal reporting is generally much more detailed than is required purely for GAAP reasons. So these kinds of things are just measured differently and tracked differently, usually in greater detail. So I just wanted to point that out, that's kind of the third layer, the third set of tracking that needs to happen, is whatever you need to do to inform your decision making around owning and delivering a business. So this is a picture that we've seen before, but it's a different way of measuring performance at the income statement level. For a manufacturer, for instance, they might look at the revenue that they'll earn from selling a particular unit of their product. And then they want to understand, well, what are the variable costs that go into selling that product? The materials cost, the cost of labor, the variable cost associated with overhead, for instance, of like the power to run a machine, for instance. They might allocate costs on a per unit basis to understand how much money they make on selling each and every unit that they sell. So the net of that is called contribution margin. So and that margin that you earn contributes to your ability to pay for overhead and other types of costs. That's why they call it contribution margin. And so those are variable costs associated with selling a particular unit. But then there's also fixed costs, like running a warehouse, for instance, is a fixed cost. Insurance is a fixed cost. Things of that nature are fixed costs that just you have to have in place in some respects, regardless of how many units you sell. And so internal accounting can often look at transactions in this regard to just take a different cut and a different cross section of the profitability of a business. So I just want to point that out. Okay, so we're going to change gears a little bit. I want to talk about external users and what they care about, how they analyze different businesses, what they're looking for when they're doing that. And I'll one in particular that I'm going to spend some time on is banks, because that's if I look at my clients, yes, some of them have investors that are looking for periodic financial information. Some of them have landlords that, as a condition of allowing you to lease their building, they want to look at your financial statements. And some of them even have insurance companies, particularly in the construction industry. Surety bond financing is a type of insurance, and surety bonds come with quite a bit of analysis on the health of a business. So they like to look at financial statements. We're going to pick on banks here today because the majority of my clients, that's why they are working with Clarke Nuber, is to help provide for some compliance with bank financing and so on. I'll say that I've never been a banker. I'm not a banker, and so these are my observations from serving my clients for the last 21 years, but they're not firsthand knowledge necessarily. It's just what I've learned and picked up on from serving those clients. So I'll share what I know, and I think it'll be helpful for you. So how do banks use this information? And really the reason that they look at financial statements is to understand, is the business that they're analyzing creditworthy? And how creditworthy are they? Is this a business that if I were to give them some money, is there a good chance that they're going to be able to pay me back? That's really what they're concerned about. So they look at this to determine if you're creditworthy. So what do they look for? So like I said, they turn to the income statement. They turn to the cash flow statement. They look at your income statement. They want to understand how much Ebitda is the company producing. They'll generally have a decent idea of you're an engineering company, you're a manufacturer in aerospace, you're a consulting firm. They'll have an idea of how much Ebitda you should be producing. They'll have an idea of how profitable are you and how are you using your cash. So they'll look at those financial statements like we talked about earlier to understand how is cash being used, how much is staying inside the business, and how profitable are you. And so then, how do they measure that? They use things called financial covenants to measure the health of a business and the performance of a business. We talked earlier about working capital and current ratio. That's a measure of your ability to pay your bills. So they will flip to the balance sheet and they'll make a calculation there. They like to look at your ability to pay for debt service, and debt service is a fancy way of saying principal and interest on a mortgage or any other kind of long-term debt. So they want to understand how are you able to pay for debt service. They call it a fixed charge coverage ratio or a debt service coverage ratio. That's another way that they measure things. And then they just look at, overall, how much equity is left inside the business. And they measure that most often by comparing equity to your total debt or your total liabilities. And for all of these things, they have different ratios and minimums that they expect to see in a healthy business. And I've got some examples here I'll show in a second, but they, like I said, they have an expectation for an eligible borrower to fit inside of these particular boxes, and that their metrics and their ratios will be in line with their expectations in order for them to lend and provide a credit facility to those businesses. And so as you're going through this and trying to determine, am I credit worthy? What would a bank think of my financial statements? One, they need your financial statements need to at least reasonably compare with generally accepted accounting principles. They need to be on an accrual basis of accounting and not a cash basis of accounting. And then the next step would be, do I fit inside of these parameters? Do I have some working capital? Is that a positive number? Am I making enough money to be able to repay the amount of debt that I might be taking on? Things of that nature. Am I leaving enough cash in the business so that I have some positive equity? That's an important thing as well. So let's look at these specifically. So the current ratio, I pulled these from debt agreements of one of my clients to provide an example. And then I also provided the way that we calculated their compliance with these ratios. So the current ratio measures, again, the difference between, it takes current assets and it divides by current liabilities. And in this case, the bank was saying that it has to be at least 1.3 to 1. And so I grabbed our calculation of their current ratio. This is a fairly large mechanical contractor. They had $34 million in current assets. They had $20 million in current liabilities. And regardless of the size of your business, you can cut out 3 decimal points there if you need to, or 6 decimal points, doesn't really matter. But the mechanics of it is really what we're getting at. And in this case, their current ratio was 1.66. And so they were above that minimum threshold of 1.3. That meant that they passed the covenant. That meant that they were a healthy business relative to the ability to pay their bills in the eyes of the bank. The next one is this debt service coverage ratio. So are you making enough money to be able to pay your bills and pay back what we think your debt payments will be on a 12-month basis? And in this case, they want to see that this coverage ratio, that there's enough cushion of 1.35 to 1. So that difference between 1.35 and 1 is some cushion that they expect to see, and they want to see at least that amount of cushion. So again, we come up with a calculation, and debt service coverage generally has these components attached to it. Ebitda, we talked about that earlier, and it's kind of a reasonable comparison to your operating cash flows. So the amount of money that you're making is Ebitda, and they expect that you're going to, from Ebitda, that you're going to pay some distributions to your owners. So they're taking that into account. So we're going to deduct that from the total, and then we're going to compare that with the current portion of your long-term debt. That's what LTD stands for. So the amount of principal that you're going to pay over a 12-month period, and the amount of interest expense that you paid over a 12-month period. So we're going to add those two things together. That's your total amount of debt that you have to pay as a result of having that loan. And so then we're going to compare those numbers. I didn't do a very good job of subtotaling here, but basically what the 7.6 is telling us is that Ebitda less distributions is your numerator, and then the current portion of long-term debt and the interest expense, if you add those together, that's your denominator, and the ratio ends up being 7.6. So this particular business is covering this ratio with plenty of room to spare, and so they're passing that particular covenant. And I've got one more for you. This debt to worth ratio. This is comparing total liabilities and equity, and in this case, the borrower wanted to see that it was no more than 3 to 1. So they know that there's going to be more debt on the books than there is equity, but they don't want it to be more than 3 to 1. If there is, then that's their kind of threshold for saying, it's too much. It's too much debt. So again, a simple calculation, the total debt on the books is almost 21 million in this particular case. If you take their total assets minus their total liabilities, that gets you to their equity amount or their tangible net worth, which is about 15 million. And when you compare those, the debt to net worth ratio is 1.4. So again, well below 3. And I would say that 3 to 1 is a pretty reasonable debt to worth ratio that banks set as a ceiling. And then back to this slide, 1.3 is a reasonable current ratio that banks are using. 1.35 is a reasonable debt service coverage ratio. So, if you were to look at your business and do the same calculations, that would give you some signal. Are we healthy? Are we credit worthy? Would a bank be willing to talk to us to help us get some financing? Okay, so I wanted, I'm not the most sophisticated PowerPoint builder on the planet. I apologize in advance for the amount of words on this slide. I'd like for this to be animated a little bit so that you're not reading so much all at once, but I'll try to break this down for you. So, what do they really want to know? Banks want to know that they can be repaid. That's really the first and foremost what they really care about. And the primary source of repayment is your operations. What they really hope to see is that your operations are churning out enough profits and enough cash that you can do what is necessary to keep the business going and repay the debt at the same time, purely based on your operational performance. However, because they're banks and professional service firms tend to be conservative and they like to contingency plan, a bank usually wants to see a secondary source of repayment and sometimes even a third source of repayment, just to make sure that if your industry hits a rough spot or for whatever reason your performance dips, are you still going to be able to repay the debt? So they look for collateral. They may ask to collateralize some equipment or real estate. They also quite frequently ask for personal guarantees. Where they'll ask the owner to sign off on it and perhaps pledge a mortgage on their house or something like that as a way to provide for that kind of collateral. And Yvonne, I see that you got your hand raised, and if you had a question, I'm happy to answer.
Yes, I do. There are, especially in the South where I'm from, there are an awful lot of businesses that are being impacted by the effects of global warming. And I'm just wondering, is it possible to buy business interruption insurance?
There is, absolutely. And we've seen, many of my clients have actually needed to file business interruption claims for a variety of reasons, whether it's, natural disasters, hurricanes and such, weather events like that. They've needed to file claims and successfully filed claims for business interruption insurance for those reasons. You've got to be careful with that and make sure that in the underwriting process that they're not excluding certain events from those policies. You want to make sure that they're fairly inclusive as to the types of things that qualify as a business interruption claim event. But absolutely, those policies are out there. Good question. So one of the other things that banks really care about is, why is the borrowing necessary? And having that story ready, I think, is important. And there's things that came to my mind about why the borrowing might be necessary. There's a concept that I think of as the cash to cash cycle, which means that when you enter into a transaction with a customer and they say, I want you to build me 1,000 widgets, you have to go out and buy the inventory for those 1,000 widgets. You have to pay for your employees to manufacture those widgets based on raw materials. You've got to pay for the packaging and shipping. and then you send it off to your customer, and then your customer has 60 days to pay you, and then they do that, and so it takes a period of time from the point when you initially are letting cash go to pay for raw materials and labor to the point where you're actually getting cash back in the door from your customer. And you've got to cover that period. You've got to cover that float. And so one way to fill in the gap there, if you don't have all of the cash on hand to be able to do that on your own, is to get a line of credit with a bank. And so having borrowing available to help cover the cash to cash cycle is a perfectly reasonable reason to borrow. Do you need money to fund an unprofitable product line? One of the things I talked about earlier was accounting data can often be used to figure out if a division or a product line or a customer relationship is profitable or not. If you find that one is not profitable, some businesses say, well, maybe if we throw some money at that, we can turn it around. And it's generally not a good answer. Banks are going to frown on that. They may not be as willing to borrow in cases like that. But a third one is that you may need help to buy inventory that's fueled by growth. You've got a brand new customer, a significant customer that wants to buy a lot of your product, but you don't have the cash in the business right now to be able to go buy that inventory to get that engine started. So you can borrow. It's kind of the same idea, that cash to cash cycle, but you can borrow to go buy that inventory to get the manufacturing process started. And then the profits from that new relationship will help you pay that debt down. So having a borrowing need for the sake of buying inventory fueled by growth is another perfectly reasonable reason to borrow, and banks would be excited about that kind of a conversation. Operating lines of credit, here are a couple notes I wanted to point out. They often are limited to qualifying receivables and inventory, and what that means is the bank, let's say that they give you a $2 million line of credit, but they say that it's limited to 90% of receivables that are aged 90 days or less, and 60% of inventory. Those are common parameters. So you could have a bunch of receivables on your books, and you could have a bunch of inventory on your books, but if it doesn't add up to $2 million, you can't actually draw down the money in that line of credit to the fullest extent. It's limited by these parameters around a subset of your receivables inventory. So that's just something important, kind of a limiter I wanted to point out. You may from time to time have to certify these balances and provide the bank with some information to help them prove out that yes, the number that you're telling me that's 90% of receivables and 60% of inventory is the right number based on what you're carrying in your books. And you may even from time to time have to do a collateral exam where a bank auditor will come in and they will do some detailed testing to make sure that the reporting that you're providing is accurate. That happens from time to time. It's not necessarily a sign of an unhealthy relationship. It's just something that banks do. Banks want to see historic profitability. If you're entering a relationship with you, they want to know that in the past you've been profitable, so that they have some assurance that, again, you're going to generate enough cash flow to be able to pay them back. But they also want to see a forecast of your future business. You've been profitable, but do you have orders on hand that give me some assurance that about the revenue volume that you're going to be generating over the next 12 to 24 months, so that I can see that, yeah, there's business coming as well, and that business will fuel the ability for you to repay the loan that I'm going to give you. They may also ask for third-party verification of your financial statements, and that's where an auditor like Clarke Nuber comes in. So I'll talk about that a little bit as a kind of a final topic. One of the reasons that we get hired to do an audit or review, a primary reason is that the company is borrowing from a bank, and the bank wants some assurance that those numbers that they're using to analyze the business are accurate. So they have a third party, an independent party like us, come in and do an engagement or a project with that company. At a base level, if a bank's going to enter into a relationship with a company, they want to see your internal financial statements and they want to see your tax returns. That's kind of universal what they're going to ask for, just as a way to better understand your business. But beyond that, depending on how much you're borrowing for, they may also ask for a compilation or a review or an audit. And those are things that are prepared by CPA firms, and they're different. I want to talk about those differences. And the font is different because the level of effort and strain and rigor that goes into these kind of goes up and up as you go from left to right. Compilations are fairly basic. Review is kind of middle of the road, and audit is a little bit more intense. I'll start out just by saying that if a CPA is involved, there's kind of this expectation gap that a CPA is doing an audit, even if they're not. And each of the three statements that I'll talk about here comes with a report that is on the CPA's letterhead that says exactly what it is that we did. We did a compilation, we did a review, we did an audit. But there's this expectation gap that it's always an audit. So I want to point that out so that if you're seeing something, take the time to read it to understand which of these three things we're getting at. I'll start with kind of the basic engagement, which is a compilation. All we're doing there is taking accounting information from you, and we're putting it in a format that looks like a GAAP set of financial statements. So we're preparing the financial statements, we're preparing some notes. We talked about all that earlier, but we're doing nothing else. We're not proving out that the numbers are accurate. We're not doing any procedures to verify that they are. We're just preparing the financial statements. And that's basically what our report says, that there's no assurance provided by the CPA. So it's important to understand. Up from that is what's called a review. So we start out with a compilation and then we add on. And now we are starting to ask some questions, and we're starting to look at ratios and do what's called analytical procedures to understand the relationships in the numbers and see if there's any goofy stuff that stands out that we need to understand better and get to the bottom of. So that there is some assurance that comes along with that kind of a report. The financial statements look exactly the same. The notes are still the same, and they're all required, but the amount of work that goes into it is greater. And we provide what's called limited assurance, which means that there's nothing that came to our attention that made us believe that the numbers are inaccurate. And then above that is an audit. So we're doing all those things that we did in review, and we're doing more than that. We're also going outside of the company to verify certain information. So we're looking at, so we would send letters to your customers, to your banks, and to your attorneys to understand different transactions that are going on. We're looking at source documents like invoices to prove out that lease payment that you made or the payroll that you ran was accurately recorded. So we're doing that on a test basis. And then we're studying internal controls of your organization to make sure that not only are the transactions recorded accurately, but are there checks and balances along the way throughout the life cycle of the transaction to make sure that that things are being taken care of to provide a little bit of extra support and reliance in the numbers. And so the technical term here is that we're providing a reasonable level of assurance. So in this case, we're saying different from a review, where in a review, we're saying that nothing came to our attention. In an audit, we're saying we did sufficient testing to feel as though the numbers are accurate, are complete and accurate based on the testing that we did. Although it's not absolute assurance, we didn't look at every single transaction, but we did it on a test basis. We feel that there's that our testing supports a reasonable amount of assurance that the numbers are accurate. So that's the difference in those things, and that's something, again, that banks ask for from time to time. And with that, I've gotten to the end of my prepared remarks, maybe a few minutes over, but still have some time for other questions that you might have about what I talked about, or anything else that might be on your mind on this topic.
Well, thank you, Pete. Your presentation really emphasizes the need for small businesses to start off on the right foot so that they can grow. A lot of really small companies who's had such a tough time this last year they don't really understand the difference between a bookkeeper, an accountant, and a CPA. And they may have somebody doing their QuickBooks for them, but they're not really getting the reports as you have just laid these out on their company. And, so if anything, one of the big takeaways on here is that the investment in professional services are critical for the longevity of your company. And, when you start, cutting back on, things like legal and accounting, odds are it's going to come back to bite you. So, I know this small company that launched their business a year ago in August. And, it's like they broke every single rule in regards to ownership, owner's equity, cost of goods sold. And, they wouldn't listen to their bookkeeper or their accountant. And consequently, they had to close their business because, they weren't making enough to even cover the fixed costs. And, it's a sad story. In this last year, really, took out a lot of small businesses. And if they had made the right decisions early on, maybe that could have been abated. But no, it's a critical resources for small business. And, so also in regards to, the lenders, the banks, the, loaning, people money, if they don't qualify for a bank, what are their options? Well, those are not good options generally. And, so my recommendation is you start at the very beginning with good legal and accounting resources, period.
Yeah, it's great advice, Leslie. Thank you for that. I would agree. I think that you can get some really wonderful advice, and if you're attached to the right relationship with professional service providers, you're getting some input on the changing dynamics out there, whether it be in the Internal Revenue Code or the legal environment or anything, just the general business environment. But I think of it as a bit of an annual physical, where particularly on the accounting side of things, we've got a number of client relationships where the bank isn't asking for something like this, but they want the review to happen or the accounting engagement to happen so that we can come in, take a look at their books, help them understand what maybe they did right and wrong, help them kind of align with where they need to be, and just kind of fix things up, tidy things up. And that kind of a relationship, even on a periodic basis, if it's quarterly or annually, is really helpful. And to your point, if when you start backing away from that annual checkup or that quarterly physical or whatever, you can start to see your, if we did that as human beings, you might start to see your physical health deteriorate. And as businesses, you start to see your financial strength and health deteriorate over time without that discipline and that rigor and that advice. So yeah, I tend to agree with you that it's a really important aspect of the health of the business. And it's not that bank financing isn't available if you don't fit inside of those specific buckets, but the banks that are willing to lend to you are going to charge you a higher interest rate. They're going to do more of the picking and poking around and collateral exams and all of those kinds of things, take up more of your time. So it's just going to be, a bigger distraction and a bigger cost than it would be otherwise. So, it's worth it to analyze this, to keep track of it, to try to stay inside those boxes as you can, or at least to know if that's something that you can do.
Well, and I was thinking also that over the last year that all of the financial institutions have probably been inundated, from small businesses seeking assistance. And, everything is compounded. The small business is short of staff, short of materials, short of resources, and the lenders are short of staff and overwhelmed by, the number of loan applications. And you really have to have a tough skin to, keep on plugging away and, being in compliance with what the lenders need and making sure that all your T's are crossed and your I's are dotted. And even though today's topic is about finance and accounting, it also has to do with your organizational skills and, your ability to deal with the paperwork. And those that cannot aren't around very long. So let me look and see if we have any more questions. I see that we don't, but with that, go ahead, Andrew.
Hi, Pete. I was just wondering, I've run into this with a lot of clients, just thinking about the last 10 of them. It's the wife of the CEO or the girl next door that needed a job right when they were starting the company that's been running their numbers. And they do okay, and they've got a functioning existence. But how would you, besides doing this entire presentation, convince them that they do need to go and have their books run through by a CPA on at least an annual basis? Because I've really run into that as a brick wall, and I'm trying to help these guys stop from failing, but they insist on it and they won't go and pay extra money down the toilet because that's just a waste of time. She's been doing a great job. Yeah. And I get the feeling that without a little bit of certification or degree, she's probably not doing that great of a job. So how would you recommend I pitch that or sell that to them?
Yeah, that's a great question and common. I mean, you're right that comes up often enough. And you know what, folks like that and the sophistication of accounting packages, even QuickBooks these days, you can get by. You can get by with that kind of a relationship with a bookkeeper, just as a, call it to keep your checkbook up to date. But are they really going to be able to produce the reports that are needed and help you analyze your business, help you find holes and help you get profitable? There's definitely more to it than that. So, the way to convince or help them understand it better. I mean, for starters, I would never go into a relationship like that or a conversation like that, rather, with the idea that the bookkeeper's got to go, the girlfriend or the girl next door has got to go. I would never go into it with that, and I would actually lead with that and prop up that person and say that they're doing a fine job, and this is just additive. So there could be some underlying fear that a conversation like that would lead to a tough conversation on the owner's part to exit that relationship, which I don't think would necessarily need to happen. But the other side of it is, there's opportunities out there that professionals that live and breathe this business every single day are going to know better. For a lot of businesses, there's credits out there from a tax standpoint that are available. That lately, because of the pandemic, there's a thing called the employer retention credit that a lot of businesses are taking advantage of, to the extent that they were paying employees to not work because of the pandemic, because they couldn't come into buildings. There's a payroll credit that the federal government is offering. There's a research and development credit that's been around for decades that the federal government offers as a way to give back to those businesses that are investing in innovation. So there's a lot of those kinds of things available, and there's all kinds of other credits available from a state and local tax perspective. So, the real question is, business owner, is your current accounting resource bringing those kinds of things to bear? Are you having those types of conversations? And if it's the girl next door, the girlfriend, or a resource like that, the neighbor, the answer to that is most likely no. And so, that's what I would expect to come out of a conversation like that is, we're going to look at your financial statements. Give us, half an hour, and we'll give you some ideas. Many of those are probably going to be more tax oriented, but some of them are going to be, hey, it doesn't look like you're doing this in accordance with GAAP. And if you wanted to approach a bank, they would put a flag up around that, and they would make you go fix it. And so it'd be much better to have that conversation now and fix it now, so that it doesn't come up ever with a bank. Those are a couple of things that I would, use as ammunition in that kind of a conversation, just to try to get it started. But first and foremost, like some assurance that, we're not going to ask you to fire that person. There's a role to play there, and they're playing that role, but your business is growing and it needs more support than he or she can provide.
Awesome, thank you.
Yeah, good question.
Thank you, Pete. That was a really great presentation. We're very thankful of your support of the SBTRC and Washington PTAC and Port of Seattle. So
I'm sorry, Leslie. I think Joe may have a question. Joe, do you have a question for Pete?
No, not a question. I just want to say thank you very much. That was a very awesome presentation, and makes a lot of sense, from above the shop floor and shop floor type of views of financial. It's a great presentation. Thank you.
Thank you.
I'd like to introduce to you Farlis Lewis, who is the buyer supervisor for the Port of Seattle. And just to note that this is being recorded. And the slideshow that she's doing today, I included in the chat. So feel free to tap into that. And if you have any questions, you can put them in the chat or raise your hand, and we'll call on you. So with that, we'll move to Farlis. So welcome aboard.
Thank you. Hi, everybody. I'm super excited to be here. PortGens are usually one of my favorite things to do because I get the opportunity to meet new vendors, meet new small businesses, and WIMBYs too. And so I have missed it for the last year when we haven't had a lot of opportunities to have conversations with the business community in person or through, digital media. So thank you very much. My name is Farlis Lewis, and I have been with the Port for almost 5 years now. The rest of my professional career, I came from the nonprofit sector where I did economic development in the United States, but I also did economic development in Central America. So I have a lot of experience working with small and micro businesses, both locally and also internationally. And then I decided to join the Port of Seattle for many reasons, but one of the reasons was because I really resonated with our mission and with our vision for who we are as an organization. So I don't know how familiar you are with who we are, but the Port of Seattle really wants to create good jobs here and across the state by advancing trade and commerce, promoting manufacturing and maritime growth, and stimulating economic development in the region. So if you're not familiar with who we are, we not only have Seattle-Tacoma International Airport, we also manage a lot of our maritime ports and the piers. And we also have property around the city, and many of the smaller parks that we have within the city of Seattle are also managed by the port. So many of opportunities for us to impact the community, for us to support economic growth around the area, and for us to be heavily involved with not just the city of Seattle, but the entire region in general. I work for a department called the Central Procurement Office, and basically what we do is we buy and contract for any and all the needs around the port. Our team is divided by or made of 4 main teams, smaller teams, and you only see 3 on the slide because the 4th one manages our data. So they take a look at everything that we do all the time and allowed us to make informed decisions because they provide us with all of the data and analytics that we need in order to plan accordingly for the future. So as you can see, we have a major construction team. We also have what we call a consulting team, and then there is purchasing, and that is the team that I sit with. So I want to talk to you a little bit about both of the counterparts and then I'm going to spend more time on the purchasing team so I can explain a little bit what I do and what my team does. And so our major construction team they manage everything that is $300,000 or above on public works. So you're probably pretty familiar with that. That team also has a smaller team that's called Small Works, and they manage and procure anything that is $300,000 or below for the public works area. Then we have our consulting team, and they do all of the procurement and acquisitions that have to do with professional and personal services. So architects, designers, that type of opportunities. And then there is us, purchasing. We do around, let's say, around $11 million a year for smaller buys. And then we have another team that manages all of our competitive procurements, and that is the team that I've sit in. And so anything that we're looking to compete, my team will acquire for the organization. And I will tell you a little bit more in detail about what type of procurement I am referring to. And I also want to talk to you about our procurement car program and how we think that is a really good fit for smaller businesses in the area. So our purchasing team basically acquires everything that has to do with goods and services that provide continuous maintenance or off-the-shelf services. We constantly get questions regarding that really thin line between purchase services and personal and professional services, because a lot of what we do is not quite clear in which category it sits. And so the definition for purchase services is anything that is off the shelf, that doesn't have to be especially designed for us, that doesn't require adjustments, but that we could just buy it, then that will be a purchase service. If it requires adjustments, if it requires a specific design, then that most likely will stay with our professional consulting services group instead of with the purchasing team. And I want to apologize because I have like 2 or 3 screens going on, and so I'm trying to look at all of them. So these are like very specific examples of the type of things that my team or our team will look for. So we look for electronic furniture, office supplies, catering, CPR training, drug testing, and that type of stuff. So as I mentioned, our team manages everything that is publicly procured. And I want to talk to you a little bit about that. So at the Port of Seattle, we have guidelines on how we need to procure services and goods. So anything that is below $50,000, we can directly buy from a supplier without having to compete it. So, and that applies for both goods and services. Anything between 50,000 and 150,000, we have a process that's called a 3 quotes process. And what that means is that we have to target specific vendors for that. And the vendors that we usually targeted are vendors that are registered with us, and vendors that we have an opportunity to know that they are in the market. And I will talk to you a little bit about that in a few minutes. And then we have our anything that is above $150,000, then we need to publicly compete. And we publish that on our Vendor Connect website. And those could take the form of a request for proposal or maybe an invitation to bid. And I will not bore you on the details of that, but just know that that is most likely what you will see on our website is anything that is above $150,000. So a few things about what is the most effective way for you to stay on up-to-date information on how to do business with us, especially if you're a company that is trying to break into the possibility of doing business with the Port of Seattle. So we have a website called Vendor Connect, and you can find it on our Port of Seattle.org, and then just look under businesses. And then when you register as a plan holder, you will receive a notification every single time that a procurement has been advertised for the Port of Seattle. Then what you do is you just read the advertisement and then you determine whether that could be a possible opportunity for you. Another very interesting tool is that we have a future procurement list. So every single Friday, there is a spreadsheet that is published on our website that tells you every single procurement that we know is coming down in the future or that we're looking at the possibility of acquiring in the near future. I haven't checked the future procurement list recently, and I apologize for that, but up to like 6 months ago, we had opportunities that were probably a year out, 2 years out, and possibly more than 2 years out, because we have larger projects that require that kind of planning. So the Vendor Connect website is probably the most effective way for you to stay up to date on what is happening and future opportunities with the board. And things that you could consider the possibility of doing business with us. So the other tip that I want to give you is that once our procurements are advertised on Vendor Connect, and once you have registered as a plan holder, then you will be able to read all of the documentation and ask any questions. Also, even if you're not registered as a plan holder, you should be able to see all of the documentation. I highly recommend that before you ask questions, you read the documentation, because we spend weeks and weeks and weeks writing the documents, making sure that we anticipate most questions and making sure that we provide you with the required information for you to make a decision of whether that procurement is a good fit for you or not. One of the mistakes that we see all the time is that smaller businesses tend to not follow directions on the RFP documents. And so that could kind of trigger for us to disqualify you from participation depending on the requirements. And so a really good example of that is custodial services. For example, if we tell you that site tours are mandatory because of the complexity of the requirements, and then later on you forget to register for the site tour and you don't attend the site tour, then you most likely will not be able to participate in the process, even though you might be a really good fit for that procurement. We won't be able to take your proposal because you didn't follow directions. So I highly recommend that you follow directions, and they're very, very clear on all of the documentations. If during the procurement process you are invited to discussions, interviews, make sure that you can prepare for those. At the Port of Seattle, most likely depending on the team that you're working with, but if you're working with a purchasing team, we tend to provide you the questions ahead of time because we want you to be prepared. We also want you to bring to the discussions and the interviews the right people to your team that will be able to answer those questions. So make sure that you can prepare, make sure that you do your research about our goals and our interests and what we're looking for so that you can tailor your discussions and your answers to those interests and our Port goals. One of the things that we see all the time with proposals is that we can see the difference between vendors that have spent a lot of time writing their proposals, and then vendors that have waited until the last minute to put together their proposals. So one of my recommendations all the time is write and then edit again, because the more you edit, the most likely we'll see that we will see a high quality product, and we should be able to tell the difference between one and the other. The other thing that I recommend is that you make sure that you understand the requirements of that particular document. So we at the Port of Seattle tend to put page limits on all of our proposals. So make sure that if we say, hey, you only have 5 pages to answer this question, that you follow that, because what is going to happen is any page over 5 pages, we will take out of your document, and then the evaluation committee will never see it. And so if you have really good information on those documents, then we're going to miss it. And then finally, for how you compete for our procurements, just make sure that when you answer your questions, you are as detailed as possible. One of the pieces that we see smaller businesses kind of trip while they are trying to compete for business with the Port of Seattle is that a lot of assumptions are made about what we know and what we don't know. And so just know that at the Port of Seattle, we do evaluation by committee. And so we have 3 to 5 to maybe 7 members on that evaluation committee, and they might come from many different areas of the port. And so if you are writing and you're thinking, oh, the Port of Seattle probably knows this, you most likely will be in a situation where we're like, oh, we wish they would have told us something about this piece, because some of the members of the committee might not know anything about that particular industry. And the first time reading about it will be your proposal. So the more detailed you are, the better you are going to be in terms of your chances of getting an opportunity with the port. So couple of recommendations of when we are on the procurement and proposal phase of the procurement. There are a couple of pieces that are not unique to the Port of Seattle, but that provide a little bit of complexity to our process. And one of them is the insurance requirements. Our insurance requirements tend to be pretty robust. And you need to understand that it's because of the level of risk that we're taking, especially at Seattle-Tacoma International Airport. We need to ensure that our safety is paramount to us and to all of our contractors. So insurance is very important. So if you are considering the possibility of doing business with us, please make sure that you talk to your broker. When you see the documents, I highly recommend all the time in all of our procurements that you take the RFP or the ITV, and then you forward to your broker and say, hey, I'm looking at the possibility of competing for this. Could you tell me how much that is going to cost me to get that level of coverage? Or could you confirm that I will be able to obtain that level of coverage? The terrible thing that you could do is go through a procurement process, get the award, and then not be able to sign your contract because you cannot produce your insurance documents. And so make sure that you double check and triple check during the procurement phase. The same thing applies for the safety plan. Most of our procurements and most of the competitive procurements that we do might have a safety plan component to it, especially when we're talking about services. If you're going to be providing services on one of our properties, you most likely will have a safety plan. So if we provide you with an example of what they could possibly look like, so make sure that you draft one just in case you get the award. And then the final thing that I would recommend in this area is make sure that you understand all of the permits that you're going to need to be able to fulfill the requirements of the contract. Badging is a very important thing for us at the Port of Seattle because you need to have access to certain areas. And so, especially if you're going to be providing services at Seattle-Tacoma International, you need to pass a background check, and your employees will have to pass that background check too. So make sure that you understand what is required and what needs to happen so that if the time comes, you will be able to fulfill the requirements of your contract. So let's say that you go through the procurement process and you are going to be on top, and we will send you a beautiful letter that says, welcome to the Port of Seattle's family. It is our intent to award you this contract. On that letter, we are going to ask you for pieces of information. So we're going to ask you for your insurance. We're going to ask you for a copy of your safety plan. We're going to ask you for bank and W-9. And then we're going to talk to you about your business classification form. And that's the form that tells us what type of business you are. And then we will talk to you about budget requirements at that particular point in more detail, and where and how all of that requirements could be met. And then we go through the phase of making sure that you sign the agreement, and then the Port of Seattle will sign the agreement. And then with that contract, then you could go to our badging office and you will be able to get your staff badge. I want to give you cautions that irregularly that process takes time, because you're going to be doing background checks on your employees, and we're going to be running fingerprints and a couple of other things depending on the location of your agreement. So that might take a few weeks. Then the other piece that we're going to have to do is we're going to have to set you up on our financial system and making sure that we understand how we're going to pay you for your services. So there's a few pieces of documentation that we're going to have to provide for you right there too. One of our biggest pain points with brand new vendors at the Port of Seattle has to do with our invoices. We tend to make, brand new providers for us tend to make a lot of mistakes on how invoices are submitted to us, how they get approved, and all of that. So during the kickoff meeting that we will have with you, make sure that you ask questions about invoices, the timely, the form that they need to be submitted, where they go, and stuff like that. And then make sure that you understand clearly who is responsible for approving your invoices, because what is going to happen is you will send it to us and then we have to run an internal process. So you need to understand the timeline and also the terms on how long it's going to take us to pay you in general. And then the final piece that has to do with the contract award, I would say, is we will always be super excited to be doing business with you. And we want you to know, as an organization, we are here to support you, and we will try to be great partners to you, because when you're successful, we are successful, and when we are successful, the community in general will be successful. So our partnerships will always be important to us, and our contractual relations will always be important to us. Okay, so once you are in your contract implementation phase, and you are, providing the services, and you're trying to navigate the Port of Seattle, keep in mind the following things. Communicate all the time. Make sure that you keep your contract administrator up to date on what is happening, of all of the successes that you're having, but also all of the challenges. I always tell my vendors, I cannot fix a problem that I don't know that it exists. I wish I could read minds, but I can. I wish I could see the future, but I can. And if I could see the future, I will probably be buying the lottery ticket so that I could share with a few of you. But unfortunately, we can't. So if you don't communicate with us, we will not be able to help you and support you the most effective and efficient way. So keep us up to date. You will have a contract administrator from the central procurement office. That's the person that administrates your contract, but then you're also going to have a department representative. And that's probably the person that you're going to be dealing on a day-to-day basis. So make sure that you are constantly setting up meetings to check in with the operational team and with the procurement representative, just so that you can talk to us about what is working and what is not working. And then make sure that you don't wait until challenging situations occur before you talk to us about operations and the challenges that you are experiencing. One of the issues that we deal with the most when it comes to some of our newer partners is that for whatever reason, you are really good at communicating with us while we're in the procurement process. And then after the contract has been awarded and you are implementing your staff and you just get super busy and it just gets really difficult for us to communicate back with you. And so if we try to get a hold of you, please answer back. Emails, phone calls are always important to us. One of the things that we see is that people are super busy, but just a simple email saying, hey, I know you're trying to get a hold of me. Sorry, I haven't been able to get back to you. I promise I will get back to you by this day so that they will know that the email addresses and the phone numbers that we have on file are actually working and know that they're going in the black hole of non-response ever. So, I did talk to you about the fact that we can do business with firms for $50,000 or below, and that we could do direct buys for those, right? And so none of those purchases we have to publicly compete. We could just go pick up the phone and call you and say, hey, here's what we're looking for. Could you please provide a quote for it? You can provide us a quote, and then we can go directly to you and buy those services. Then another tool that we have at the Port of Seattle is our procurement card, or what we refer to as a P card. So the P card program was designed to give some of our staff flexibility and efficiency. And so we have several levels of operations at the Port of Seattle that and staff that regularly make repetitive purchases for very small values. And we understand that trying to put them into the process of getting a purchase order set up and finding quotes and all of that might just not be the most efficient way for them to procure those services. So the Port of Seattle created our procurement card program. And so if our personnel that usually have access to a P card are administrative assistants, people from our team, from the central procurement team, and then a couple of our people from our maintenance team. So marine maintenance and aviation maintenance also have a procurement card. And so they can do a smaller buys that are $5,000 or below, including shipping and taxes. And what they can do is whatever is it that they're looking for. And if you're selling that, they can pick up the phone directly and call you and make that purchase with you and pay with the credit card. So that doesn't require a competitive procurement process either. And it's a really good and efficient tool for our personnel, but it's also a really good opportunity for you to be able to have kind of entry-level experience with the Port of Seattle. The really important part about the procurement program is that it is designed as a method of ordering, not as a method of payment after the fact. So what you will experience is that people will call, place the order, and they immediately will pay for the services or the goods that they're purchasing from you using their P card. Our P card program is actually quite robust at the Port of Seattle. I think, if I remember correctly, the last numbers that I saw is that we did around $11 million in 2019 with our P card. And so, as you can see, there is tons of opportunities there for you to be able to tap into that resource. And our small business and our diversity and contracting team will probably be the best resource for you to talk to them about how you get involved with the P card program and what a good resource for you it could be. So with that, I am done with my presentation, guys. So if you have any questions.
So thank you, Farless. This is Leslie, and I have some questions that I thought maybe we could go into a little bit of depth on. In your presentation, you mentioned about identifying your business classification. And in regards to business classification, can you tell us if you have set-asides or goals for certain designations? You know, how do you view the classifications? You know, just small business versus not small. Anyway, if you could tell us a little bit more about that.
Yeah, definitely. So we at the Port of Seattle have a diversity in contracting policy, and our diversity in contracting policy centers around women minority business enterprises. So we have set up goals to triple the number of WIMBYs that we do business with, and to also increase the total number of dollars that we spend with WIMBY firms. The really good thing about our program is that you do not have to be certified in order to participate in our program at the Port of Seattle. So self-declaration is totally okay and totally acceptable, which is a pretty big deal for a lot of small businesses in the WIMBY community. And it was a decision that the Port of Seattle made on a very systematic way, because we wanted to make sure that some of those barriers were not there for the firms that wanted to do business with us. So we do have, we don't have any set asides because it's against the law. But we do have aspirational goals in some of our contracts. And so depending on the possible opportunities and depending on what we see in terms of complexity, some of our procurements have aspirational goals. And so a really good example of that is custodial services. 20% of the all of the procurements that we have advertised for custodial services this year have an aspirational goal of 20% participation. So that has been pretty successful for us, and we have a few other agreements that also have aspirational goals. So no set asides, but aspirational goals and business and WIMBY participations. We used to also have a pretty robust small business program. But what we did was we did a study, and we found that a lot of the small businesses that we were doing business with were thriving and were doing really well, but while the WIMBYs were kind of falling behind. And so we decided to center around our women minority business enterprise community to make sure that we could support that community to our best possible way.
So does that also include the DBEs, the Disadvantaged Business Enterprise certification, which is not self-certified? That is actually either state or federal certified. And then what about veteran-owned or service-disabled veteran-owned small businesses? Do they come into play on that at all?
So unfortunately, we don't have our veteran-owned part of our WIMBY participation. But of course, if you're a veteran-owned business, we're super happy to have you. So, but unfortunately, it will not count towards aspirational goals.
Okay,
so I see somebody from the Port of Seattle's hand is up.
So it's a mystery person from the Port of Seattle. So
hi, it's Tamika. I'm on the phone. Hi, Farless.
Hey, Tamika.
Hi, great presentation as always.
Thank you.
I wanted to, excuse me, make a comment regarding the DBE and the veteran. So we have two separate programs. So when there are projects that the FAA funds, there are DBE goals. And like you said, Leslie, those businesses have to be certified at time of bid. So those goals are set based on the actual project, the scope, and the availability of DBEs for those scopes just for that project. And then as far as the veteran goal, like Farley said, if, you know, businesses identify as veteran, that's wonderful. What we have found based on our assessment is that we will probably in the next couple of months, probably next year, do a pilot to see how many businesses actually are identifying as veteran, and then determine putting a set goal depending on the project. So that is in the works, but again, it'll be more or less a pilot.
So that's really good news to hear. Thank you, Tamika, for adding that to our conversation.
You're welcome.
For our Port of Seattle friends here, another question that I have is in regards to badging. And because of the potential for federal funding, when you do the background checks, do you also look in the federal database for the excluded parties list system for companies or individuals that have been excluded / blacklisted by the federal government?
We actually do, and we do it before an award is actually made. So if you are the winner of one of our procurements, before we send you a notice of intent to award, we are going to check on SAMs. Yeah, we do. And because we're required by law to do it, and because of our, not necessarily just because of our federal funding also, but also because of some of the requirements that we have in terms of our policy and our procurement policies. So you're absolutely right. We will check, we will double check that you're not listed in there before we will send you a notice of intent to award.
Okay, and Tamika, did you have more to add to that?
Yes, so as Farley stated, they would do that on their end. And we also do that on the DBE side too, because again, with it being federal funds, we have to ensure that their firms are actually, certified. They're not, they don't have any criminal issues or anything of that nature. So I, excuse me, I or Tina or me and the director would also check that, and that has to be checked same before the contract is actually executed, because for the DBE side, if a prime lists a DBE sub that has been disbarred or has some criminal sanctions against them, they wouldn't be able to use that DBE, and we would have to go back and look at their actual bid proposal and submission. So again, like Farley said, we check, we double check. Again, we're required by law.
Thank you. And with that, Washington PTAC, when we're counseling small businesses in regards to government contracting, one of the things that we emphasize to them is the critical need for the HR department of the company to have the report from the EPLS, in each individual's personnel file. So if it's a CFO or the CEO or the project manager, whoever has responsibility on any federal contract, they will, we recommend that they print out the report and put it in the individual's folders so that, if there's any kind of an audit or any discrepancy, they'll have that right at their fingertips. So thank you. And then my last question is in regards to the invoicing process.
Mm-hmm.
And because so much of what we do is federal agencies are all over the place in regards to the process for invoicing.
Mm-hmm.
And the Department of Defense uses what's called the wide area workflow, which is an online invoicing system. And so can you briefly describe the process that you have for invoicing? Is it any of the traditional paper submission, or are you doing things online?
We are doing online as much as possible. We really at the Port of Seattle take our environment and our environmental commitments very seriously. And so we are trying to transition as an organization away from paper as much as possible. And so part of that process has to do with our invoicing. So you're absolutely right. We have a system called CoreCentric, and most of our vendors email the invoices to CoreCentric. Then once that occur, our AFR team, our accounts payable team will get a notification, and they do the back work on it where they identify who the invoice should go to for approval and for double checking. And then once that person get a notification, they will do the things that they need to do in the background. And then the invoice, if there is no problems and the services have been invoiced correctly, then the invoice will get approved. Then our accounts payable team will do their final check, and then that will happen. You will receive your deposit most likely, because that's the other thing. The Port of Seattle is really trying to move towards ACH because we understand that paper checks tend to get lost and they provide some challenges too, but we do have the option for you to get paid via paper checks if that is what you prefer and what fits better for your business model. So what is really important about invoicing though is that we provide all of those directions on our purchase orders. And so if you don't follow them correctly, then we're going to be falling behind on your payments because you didn't send it to the right address, or because you thought that you were going to send it to their contract administrator instead of submitting it to the right place. So just make sure that you follow the directions. And if you have any questions, always pick up the phone and call your contract admin, and your contract administrator will be able to provide you with the guidance on how to do it. In general, we do net 30 for payments, and this is very important because part of our WEMB participation goals have to do with prompt pay. And so we talk to primes about, paying, even though the Port of Seattle hasn't paid them yet, because we do have some challenges at the beginning, but we want to make sure that our WEMB partners are being paid on a prompt way so that they don't face the challenges that, to pay their employees on time and making sure that everybody is being taken care of. So that is another piece that we take very seriously at the Port. So net 30 is our a standard net payment terms, but we also have, depending on who we're doing business with and the business needs, there is a possibility for a little bit of flexibility there if we know ahead of time that that is what the small business is going to require. So always talk to us if net 30 doesn't fit your financial model and you need payment that is a little sooner than that. And then if we can reach an agreement, we will do our best our hardest to make sure that we make it work for you and for us.
So terrific. Thank you so much. I know I've kind of taken a lot of the time on the questions. So we'll open this up to any of the other participants. If anybody else has any questions, Joe or Yvonne or Lisa or Andrew.
No, I don't have any. It was a very good presentation.
I was actually curious, something you said about the set-asides are illegal when it comes to port procurement. Is that what you said?
Yeah, so there is legislation at the state level, I-200, that forbid us from making awards based on race or gender. And so for that particular reason, we need to be super careful on how we make our award decisions at the Port of Seattle. We made award decisions based on technical and financial capacities. And so a lot of our competitive procurements have what we call the best value approach. So your technical expertise and your financial offer to the port, a combination of that offer us the best value, and that's most likely how we're going to make award decisions when it comes to our competitive procurements.
Makes sense. Right, thank you.
Any other
Carla?
No, thank you. I just wanted to say thank you, and that answered my question on what the basis of award was going to be, and it could change from solicitation, but sounds like you guys are going for the best value, and that makes sense. So thank you very much. Appreciate it.
Yeah, we do also a lot of, several, depending on the complexity of the requirements, we might do, lowest bid too. But what the good news is that in every one of our every document that we publish, we will tell you exactly how you're going to be evaluated, if it's based on just lowest price or if it is going to be based on the best value. So you will know exactly what we're looking for and how you can explain whether you're a good fit for that requirement that we're looking for. So if you guys don't have any questions, I did forget to talk to you about supply chain and the challenges that we are facing at the Port of Seattle with the current challenges of our supply chain. We the last year has made in the purchasing department has made our life very, very interesting because we had to look for products that were not necessarily the products that we were currently looking for. And then, we faced challenges like the entire country trying to find the same exact products that we were looking for. And we are now seeing some of the, we're exiting that stage, but a lot of the industry that we work with have continued to experience some of those challenges. And it doesn't necessarily mean it has to do with raw materials only, but it also has to do with labor, like we are also aware at this particular point. And so, part of what we're doing is we're being super creative. We're thinking outside of the box. We're tapping into markets that we have never tapped before. We're also trying to stay in communication with our supply chain and with providers that we haven't had communications with in the past, because they're switching models and they're switching businesses. And so they're trying to also get creative. So our lines of communications has been brought up a little bit more than what we had before. So I highly, highly recommend that if you are thinking about doing business with us, or if you are wondering what we're doing for a specific product, just email, pick up the phone and call us. We are always here. We try to be responsive as much as possible. And we are being very, very creative and considering all the possibilities out there so that we can meet the needs of our customers.
Thank you, Farlis. One of the things that I wanted to ask you also before we wrap it up today is those of us that are not on the west side of the state don't have the personal experience with the Port of Seattle other than maybe the airport or the ferries. So can you tell me, what all is your scope over there, and not necessarily ferries, but the cruise ships and stuff. So what all are you guys covering over there?
Yeah, so I mentioned it at the beginning. So we do from our beautiful airport all the way to our maritime terminals. So Terminal 5, Terminal 46. So not just the shipping, not just the cruise ship, but also all of the fishing vessels. Terminal 5 is where all of our big fishing boats kind of show up. So we do that, and we also have parks around the city. So we do maintenance, and we make sure that our citizens get to enjoy some of those parks. And on top of that, we also have real estate. So the complexity and the broad spectrum of what the Central Procurement Office buys varies significantly depending the line of business that we're serving. And purchasing serves the entire organization. So you will find us buying computers for our personnel, but you could also find us buying some type of environmental testing. That could be a product or that it could be a service. One of the most interesting things that I am currently buying is I'm buying banking services for the organization. So we're looking at our banking contract is about to expire. So now we're trying to figure out who the banking provider is going to be for the entire port. And then we have couple of our buyers right now are looking into buy maintenance agreements for our generators. We rent equipment, we buy vehicles. It is just very, very broad in terms of goods and in terms of the services that we purchase for the entire organization.
So you mentioned, you know, a lot of maritime type things. And so do you work with the Department of Transportation, or are you like the US DOT? Or are you guys like two totally separate things? Or do you cross paths? How does that work on the maritime side?
Yeah, we do some collaboration. Some of the projects that we do ourselves because we own the land and, you know, the facilities itself. But it could be a combination of both. We do have to partner with our federal partners because depending on what we're doing and depending on the scope, so there is always a little bit of collaboration, and sometimes there is a lot of collaboration. So it just kind of depends on the scope of what we're working on.
So does the port actually own like vessels, you know, like I don't know, tugboats and, you know, things like that?
You know, I actually don't know, to be honest with you. I actually don't know, but I could find out and let you know.
Well, and, you know, and if that's like a contractor, you know, that provides tugboats, you know, that's one thing. But if, you know, you actually own the vessels and they need maintenance, you know, then, you know, I have a lot of clients like out of Port Angeles that do a lot of maritime. And so, you know, maybe their services from the port of Port Angeles may be something that you're looking for, you know, out of the Port of Seattle for, you know, the shipbuilders or, you know, whatever, the big cranes or something, whatever you're operating over there. So
yeah. So this is another plug for Vendor Connect. So tell your customers to go into Vendor Connect and register on our website so that they can stay up to date on possible opportunities with the port. They get the opportunity to say, you know, they can, when they register, they can enter the ASCII codes. And so they could say, hey, this is the industry that we're interested in. So the website will kind of target it, that specific industry when we publish any opportunity. So that is definitely the most effective way to get up-to-date information when it comes to our procurements.
So I did post in the chat two of the links, one on Vendor Connect and then one on the future opportunities. But just on the Vendor Connect, you can really drill down and filter things, you know, specifically to your industry. And, you know, it looks pretty user friendly. So I think that, you know, it's easily researched by small businesses. So it's a really good resource, and Washington PTAC will continue to promote that information to our clients. So thank you so much.
Yeah, thank you for posting the link for me. I appreciate it.
Carlos, I do have a question. Earlier you mentioned that the PCAR diversity program allows any purchases at or below 5,000. So when we have a lot of startup business that may want to get on your radar for goods and services, how do they also find out by Vendor Connect that what you're looking for those small purchases, or is there a way to find out?
No, you see, our PCAR program functions more on an individual basis because we leave those decisions to the PCAR holder. So we unfortunately don't have a centralized less like our Vendor Connect website, right? That tells you, oh, here's what we're looking for. What it is important is that we do have an opportunity for you to let us know that you are a WEMB firm, and we're currently working with our diversity and contracting team trying to figure out a way to create a database for WEMBs, so that we can specifically provide that list of possible WEMBs and non-WEMB firms to our P card holders, so that they know that if they're looking for a specific product, they can go and do some research on that area. But unfortunately, right now, we just don't have a tool that is centralized when it comes to the P card. So it is just you as a vendor, you're going to have to do a little bit more of the lead work to make sure that you get on our radar by emailing and phone calls, and staying in close contact with our diversity and contracting team.
Okay. And then we could probably get through to the team through contacting you. Is that correct?
Yes, definitely.
Thank you.
Yeah.
Okay, so last call for any additional questions, concerns, or commentary. So I would like to thank our speakers today. Earlier, we had Pete Miller from Clarke Nuber, and Farless came today to give us, a really good comprehensive overview on Port of Seattle procurement. And so with that, I'd like to thank them and everybody who attended today. And I was going to hand it over to Aisha and let her do the next steps in this.
All right, thank you, Leslie. And then thank you everyone for coming to today's event. Thank you to the port, like Leslie said, and to our presenter as well. Once again, I'm with the SBTRC, so I can definitely help you with anything that you need, whether that's in terms of like getting connected to resources or just anyone to help you with your business needs. So again, thank you all for coming, and we hope that you consider attending some more classes that we'll be hosting throughout the rest of the week.
Tamika, would you like to say a few words?
Hi, good afternoon again, everybody. Sorry I had to be on the phone. I was driving, so I had to be hands-free. Again, thank you. I have enjoyed both of the presentations. Again, as I said in the very beginning, use this as a great resource and tool. For sure, if you haven't registered on Vendor Connect, that is, like Farless said, a very great, good starting point for you to definitely have your business out there. And one of the things that I like to just note as far as Vendor Connect, it's a free database. It's searchable by not just the Port of Seattle, but also outsiders. So again, if you are trying to build up your business, as well as work with the Port of Seattle, Vendor Connect is definitely the place that you should start. So again, great presentation, continue to network. The goods and services is going on, I think it's for the next 6 weeks, and then A&E for another 6 weeks. So use this time, network. The resources are free. Like Aisha said, she can help you. If you have some questions related to any of the sessions, as well as Leslie. And again, I encourage you to just network and ask questions. And thank you again, everyone. Really appreciate it.
Thanks, Tamika.
Thank you.
And thanks, Farless. Okay, well, with that, I think we'll call it a day. We're a little bit early, but it's still daylight outside. So hope you enjoy the rest of the afternoon, and we look forward to continuing our series starting Tuesday on the A&E track, and then again next Thursday. If you have any questions, give us a call, and Washington PTAC is here to help you. The Small Business Transportation Resource Center is here to help you. Port of Seattle is here to help you. So give us a call or drop us a line anytime. So thank you so much.
Thank you,
Thank you.
guys.
Thank you.
Bye. Have a good one.
All right, thank you.